The relentless tide of market panics, a phenomenon that has haunted financial landscapes for centuries, often appears as an unstoppable force of nature, a sudden, inexplicable tempest born of rumor and fear. But are these cataclysmic events truly inevitable? Or can they, in fact, be meticulously engineered, woven into existence by the calculating hands of ambitious men? Today, we embark on a profound journey into the heart of Wall Street's inaugural Great Crash, a seismic event that not only reshaped American finance, but also laid bare the intricate mechanisms through which panic can be manufactured. We will dissect its origins, unravel its complex causes, and expose the precise machinery that brought it into being, drawing invaluable lessons that resonate with startling clarity in our contemporary markets. The echoes of this historical upheaval offer more than mere anecdotes. They provide a crucial framework for understanding the perennial dance between human ambition, systemic vulnerability, and the volatile psychology of the crowd. To truly grasp the enduring dynamics of financial markets, one must first comprehend the foundational episodes that forged their very character. Our guide through this tumultuous epoch, a man whose insights remain as sharp and pertinent today as they were over a century ago, is none other than Henry Clews, a titan of his era, whose first-hand accounts and penetrating analyses offer an unparalleled window into the soul of Wall Street. His perspectives are not merely historical records. They are a timeless masterclass in recognizing the subtle currents that precede a storm and the deliberate actions that can unleash it. For any serious participant in the modern financial arena, understanding these historical precedents is not an academic exercise, but a vital component of strategic foresight. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. And remember to return to the channel in difficult times when trading isn't well. The period immediately following the American Civil War was a crucible of profound economic transformation, a time of unprecedented dynamism and burgeoning ambition that profoundly reshaped the nation's financial landscape. The war's end unleashed a torrent of pent-up energy, redirecting vast resources and human capital from military endeavors to industrial expansion and infrastructural development. This era was characterized by an almost insatiable appetite for growth, an optimistic fervor that permeated every segment of society and fueled a speculative frenzy across various markets. Railroads, manufacturing, and agricultural output surged, creating new avenues for wealth creation and, inevitably, for speculative excess. Wall Street, still a nascent but rapidly expanding financial hub, found itself at the epicenter of this economic maelstrom. It was a frontier town in spirit, despite its burgeoning brick-and-mortar grandeur, operating with a remarkable degree of freedom, and some might argue a dangerous lack of oversight. The regulatory frameworks that we now take for granted were largely non-existent. The concept of governmental intervention to stabilize markets or protect investors was still largely alien. This environment fostered a culture of audacious risk-taking, where fortunes could be made and lost with breathtaking speed, often on the back of daring, sometimes reckless ventures. At the very heart of this vibrant yet volatile economy lay gold, not merely as a precious metal, but as the foundational currency of the nation, the ultimate arbiter of value. The United States, operating on a bimetallic standard that had been disrupted by the war's inflationary pressures and the issuance of paper greenbacks, still held gold in paramount regard. Its price fluctuations had immediate and profound implications for international trade, domestic commerce, and the overall stability of the financial system. Gold was the central asset, the ultimate store of wealth, and therefore an irresistible magnet for speculation. Its scarcity, its tangible nature, and its direct link to the nation's creditworthiness made it the prime target for those seeking to exert control and amass extraordinary wealth. The gold market was a theater of constant activity, where brokers, merchants, and financiers engaged in a relentless struggle to predict and influence its movements. This intense focus on gold, coupled with the absence of effective regulatory mechanisms, created a fertile ground for market manipulation. There was a high tolerance for risk, an unspoken acceptance that the game was inherently fraught with peril, and that the cunning and the bold would naturally rise to the top. Investors, both seasoned and novice, were often driven by a potent mixture of ambition and a fear of being left behind, a psychological cocktail that made them particularly susceptible to manipulation. The market was a wild, untamed beast, and those who dared to ride it did so at their own considerable peril. Yet the lure of immense profits proved irresistible for many. This laissez-faire ethos, while fostering innovation and rapid growth, simultaneously sowed the seeds for profound instability, making the financial system acutely vulnerable to the machinations of powerful individuals who understood how to exploit its inherent weaknesses. It was within this specific confluence of rapid growth, speculative fervor, and regulatory vacuum that the stage was perfectly set for the events that would culminate in the first great crash. The stage for the gold corner was set by two of the most audacious and formidable figures in American finance, Jay Gould and Jim Fisk. These were not men of quiet contemplation or ethical restraint. They were predators of the highest order, brilliant strategists driven by an insatiable hunger for power and wealth, utterly unburdened by conventional morality. Gould, the shrewd, calculating mastermind, possessed an intellect sharp enough to dissect complex financial systems and identify their vulnerabilities, while Fisk, the flamboyant, boisterous showman, provided the public face and the necessary bluster to execute their audacious schemes. Their ambition was boundless, their influence far-reaching, and their strategies ruthlessly effective. Their plan, conceived with a breathtaking scope, was to engineer a complete corner of the nation's gold supply. They aimed to buy up as much gold as possible, thereby creating an artificial scarcity that would drive its price to unprecedented astronomical levels. The premise was simple yet profoundly disruptive. Control the supply, dictate the price. This was not merely a speculative gamble, it was an attempt to seize control of the very lifeblood of the American economy. To execute such a daring maneuver, Gould and Fisk understood they needed more than just capital. They needed political immunity. They recognized that the U.S. Treasury, holding vast reserves of gold, represented the only entity capable of breaking their corner. Their strategy thus extended beyond the financial markets into the corridors of power. They cultivated close ties with members of President Ulysses S. Grant's administration, including Grant's own brother-in-law, Abel Corbin. Through a combination of lavish gifts, persuasive arguments, and veiled threats, they sought to convince the president and his inner circle that a high gold price was beneficial for the nation's agricultural exports, particularly cotton, and thus that the government should refrain from selling any of its gold reserves. Their objective was to secure a promise, or at least a strong indication of governmental non-intervention, effectively neutralizing the only force capable of thwarting their design. This political leverage was as crucial to their plan as the financial leverage they employed in the market. Simultaneously, Gould and Fisk embarked on a sophisticated campaign of psychological warfare, manipulating public opinion and market sentiment through a relentless barrage of rumors and disinformation. They used their extensive network of brokers, journalists, and political operatives to spread false narratives, suggesting that the government was indeed aligned with their views and would not release its gold. They fueled the speculative fervor, enticing ordinary investors and smaller brokers to join the buying spree, creating a self-fulfilling prophecy of rising prices. They understood that fear and greed were powerful motivators, and they expertly played upon these human weaknesses, encouraging others to speculate wildly, knowing that these lesser players would ultimately bear the brunt of the inevitable collapse. Their tactics were a masterclass in market manipulation, demonstrating a profound understanding of how to orchestrate a panic not through brute force alone, but through a calculated assault on information and psychology. The gold market became a giant, intricate web, with Gould and Fisk at its center, pulling the strings of finance, politics, and public perception, all converging towards their singular, audacious goal of monopolizing the nation's most valuable asset. The intricate details of their machinations, from the quiet conversations in Washington drawing rooms to the frantic telegraph messages across Wall Street, illustrate a level of premeditation and strategic depth that was truly remarkable and terrifying in its scope. The ethical boundaries were not merely pushed, they were utterly obliterated, demonstrating a cynical pragmatism that placed profit above all else. They were building a house of cards, but they were doing so with a level of architectural precision that made it appear, to the unsuspecting, as an unshakable fortress of wealth. These timeless strategies, these first-hand accounts of the men who shaped American finance, are not mere memories lost to time. They are meticulously documented principles, a masterclass in financial strategy and human psychology. For those who wish to truly understand the methods of the old veterans, there is no greater resource than the complete, unabridged new edition of 50 Years in Wall Street. This is not simply a book of history. It is a 2-volume, 1,000-page mentorship with Henry Clews himself. Within these pages, you will walk side by side with him as he navigates the treacherous currents of the Civil War loans, weathers the panics that wiped out fortunes, and dissects the methods of titans like Vanderbilt, Drew, and Gould. You will learn to recognize the squalls before they have passed, to cultivate the self-reliance necessary for success, and to understand the true nature of speculation not as a gamble, but as a great productive force in our economy. This new edition, complete with all the original photographs, offers you the chance to gain the experience of a 50-year veteran without paying the market's usual tuition fee of devastating losses. It is an indispensable guide for any man who seeks to command his own financial destiny. The link to acquire this invaluable mentor in print is in the description below this video. The climax of this audacious scheme arrived on Friday, September 24, 1869, a day forever etched into the annals of American finance as Black Friday. The preceding days had seen the price of gold, driven by the artificial scarcity engineered by Gould and Fisk, and fueled by their relentless disinformation campaign, soar to dizzying and unsustainable heights. Brokers and investors, caught in the speculative fervor, had bought heavily, often on margin, convinced that the price would continue its upward trajectory indefinitely. The atmosphere on Wall Street was one of frenetic activity, a mixture of exhilaration for those seeing their paper fortunes swell and mounting anxiety for those who had bet against the rising tide. The Gould Room, the epicenter of this financial maelstrom, buzzed with an almost palpable tension, a sense of impending inevitability. The price of gold, which had hovered around $130 per ounce just weeks before, rocketed past $160, then $162, threatening to breach $165. Each tick upward sent shivers of both delight and terror through the market participants. Many smaller brokers and investors found themselves in an increasingly precarious position, unable to meet their margin calls or fulfill their obligations as the price surged beyond their wildest expectations. They were trapped, caught between the insatiable demand for gold and the rapidly diminishing supply. The illusion of perpetual ascent, carefully constructed by the manipulators, was about to shatter with devastating force. The entire financial system teetered on the brink, and the panic, once a psychological weapon, was now a tangible, terrifying reality. In this moment of extreme tension, the crucial turning point arrived, a development that Gould and Fisk had desperately tried to prevent. President Grant, finally realizing the extent of the manipulation and the severe economic damage it was inflicting, and having been alerted to the true nature of the conspiracy by dissenting voices within his administration, made a decisive and unexpected move. He ordered the U.S. Treasury to sell a substantial amount of its gold reserves, specifically $4 million worth. This decision, a direct and forceful intervention by the government, was a thunderclap in the financial world. The news, relayed through frantic telegraph wires, hit the Gould Room like a tidal wave. The artificial scarcity, the bedrock of Gould and Fisk's scheme, instantly evaporated. The market, which had been driven by an illusion of limited supply, suddenly faced an overwhelming influx. The consequences were immediate and catastrophic. The price of gold, which had been climbing relentlessly, plummeted with breathtaking speed. In a matter of minutes, it crashed from $162 to $135, wiping out paper fortunes and solvency alike. The euphoria of the morning transformed into abject terror. Brokers who had bought gold at the peak found themselves utterly ruined, unable to cover their positions. Margin calls went unanswered, leading to widespread defaults and bankruptcies. The floor of the gold exchange descended into utter chaos, a scene of frantic shouting, despair, and disarray. Businesses across the nation, dependent on the stability of gold for their transactions, faced immediate and severe disruption. International trade was paralyzed, and the credit system seized up. The financial chaos of Black Friday reverberated throughout the American economy, leaving a trail of ruined lives, shattered businesses, and profound distrust in its wake. The government's intervention, while ultimately necessary to break the corner, unleashed a cascade of destructive forces, demonstrating the immense fragility of a market manipulated to such an extreme degree. It was a stark and brutal lesson in the perils of unchecked speculation and the devastating power of manufactured panic. Henry Clews, a man whose professional life spanned 5 decades on Wall Street, observed these events not merely as a participant, but as a profound student of human nature and financial dynamics. His perspective on Black Friday was one of piercing clarity, devoid of the emotional hysteria that gripped so many. He saw with a dispassionate eye the raw psychology of the crowd laid bare, the infectious greed that propelled prices skyward, followed by the paralyzing fear that sent them crashing down. He meticulously documented the actions of the manipulators, Gould and Jim Fisk, dissecting their elaborate scheme with an almost forensic precision. For Clews, the panic of 1869 was not an accidental convergence of unfortunate circumstances. It was a deliberately manufactured crisis, a product of calculated manipulation and a cynical exploitation of inherent human weaknesses. He recognized that Gould and Fisk had not merely gambled on a market trend. They had actively engineered the conditions for a corner, skillfully weaving a web of political influence, disinformation, and speculative pressure. Their genius, in Clews' eyes, lay in their profound understanding of how to orchestrate a narrative, how to create an illusion of scarcity, and how to leverage the very human desire for quick riches against the unsuspecting. Clews was particularly critical of the ethical standards prevalent in that era, or rather, the glaring absence thereof. He viewed the actions of Gould and Fisk as a profound betrayal of market integrity, a testament to the dangers of unchecked ambition and the pursuit of profit at any cost. He lamented the culture of irresponsible speculative practices that allowed such schemes to flourish, where the welfare of the broader economy and the trust of individual investors were sacrificed on the altar of personal gain. He understood that while speculation in its purest form could be a productive force, driving capital towards growth and innovation, it became a destructive menace when divorced from ethical considerations and subjected to the whims of unscrupulous operators. Clews' analysis extended beyond merely describing the events. He delved into their profound and lasting consequences. He detailed the ruinous effects on market confidence, the widespread bankruptcies, and the personal tragedies that befell countless individuals who had placed their trust and their savings in a market that had been so ruthlessly exploited. He saw how the actions of a few powerful men could erode the very foundations of trust upon which a healthy financial system depends. The panic of 1869, as viewed through Clews' lens, served as a stark warning, a vivid illustration of the precarious balance between opportunity and exploitation, and the enduring vulnerability of financial markets to the darker impulses of human nature. His observations were not just historical records. They were a timeless treatise on market psychology and the essential need for both ethical conduct and robust oversight to prevent the recurrence of such devastating events. He understood that the lessons learned from Black Friday were not confined to that specific year, but represented universal truths about the perennial challenges of financial governance and individual prudence. The wisdom gleaned from the past, particularly from seismic events like the Black Friday Panic of 1869, offers an enduring and invaluable compass for navigating the complexities of contemporary financial markets. Henry Clews, with his unparalleled experience, concluded that market cycles, speculative bubbles, and subsequent panics are not isolated incidents but rather recurring phenomena, driven by immutable aspects of human nature. He recognized that while the specific instruments and technologies of finance may evolve, the underlying psychological forces of fear and greed remain constant, acting as potent catalysts for both irrational exuberance and precipitous collapse. This timeless insight underscores the critical importance of understanding market psychology, not as an abstract academic concept, but as a practical tool for informed decision-making. Investors and traders who grasp the fundamental roles that fear and greed play in driving collective behavior are far better equipped to resist the allure of speculative frenzies and to avoid the pitfalls of widespread panic. They learn to recognize that extreme market movements often reflect emotional rather than fundamental shifts, allowing them to maintain a more rational and disciplined approach. Clews' historical accounts serve as a powerful reminder of the imperative to develop a keen sensitivity to the signs of manipulation and the pervasive influence of informational noise. In an age saturated with instant news, social media chatter, and algorithmic trading, the ability to discern credible information from deliberate disinformation, to distinguish genuine market signals from orchestrated distractions, is more critical than ever. The tactics employed by Gould and Fisk, while crude by today's technological standards, were fundamentally about controlling the narrative and distorting perceptions, a strategy that remains frighteningly effective in our hyper-connected world. Recognizing the subtle cues of coordinated action, the sudden amplification of rumors, or the creation of artificial scarcity empowers individuals to protect themselves from becoming unwitting pawns in someone else's game. Furthermore, the lessons of 1869 emphatically underscore the enduring significance of sound financial principles, diversification, robust risk management, and a steadfast commitment to fundamental analysis. In an environment where the allure of quick profits can be overwhelming, the historical record consistently demonstrates that those who adhere to these bedrock principles are far more likely to weather market storms and achieve long-term success. Diversification, the spreading of investments across various assets, acts as a crucial buffer against the concentrated risks exposed by the gold corner. Effective risk management, the careful calibration of exposure to potential losses, prevents individual setbacks from becoming catastrophic failures. And a fundamental approach to investing, one that prioritizes intrinsic value and long-term prospects over short-term speculative movements, provides a stable anchor in turbulent times. Clews' legacy implores us to look beyond the immediate headlines and the fleeting trends, urging us to cultivate a deeper, more nuanced understanding of the forces that truly shape market outcomes. His insights are a clarion call for prudence, discipline, and a profound respect for the lessons etched in the annals of financial history. They serve as a powerful antidote to the perennial temptation of quick riches and a potent reminder that true wealth is built not on fleeting speculation, but on enduring principles and a clear-eyed understanding of the market's enduring psychology. The challenges may change, the players may differ, but the fundamental dynamics of human behavior in the face of financial opportunity and peril remain remarkably constant. The saga of Wall Street's first great crash in 1869 stands as an indelible testament to the profound truth that market panics are not always acts of God or inevitable forces of nature. Instead, as revealed through the astute observations of Henry Clews, they can be meticulously manufactured, skillfully woven into the fabric of the financial system by individuals driven by avarice and unburdened by ethical constraints. The Gold Corner, orchestrated by Gould and Jim Fisk, was a masterclass in market manipulation, demonstrating how political influence, calculated disinformation, and the exploitation of collective human psychology Specifically, the potent interplay of fear and greed can be weaponized to create an artificial crisis of staggering proportions. The events of Black Friday laid bare the inherent vulnerabilities of an unregulated market and the devastating consequences for individual investors and the broader economy when trust is eroded and integrity is abandoned. Clews' enduring analysis illuminates the core mechanisms of this manufactured panic, revealing it not as a random occurrence but as the logical outcome of deliberate actions designed to create scarcity, inflate prices, and then profit from the ensuing chaos. His insights serve as a powerful reminder that while the tools and technologies of finance may evolve with each passing generation, the fundamental aspects of human nature that drive financial markets remain remarkably constant. The allure of quick profits, the susceptibility to rumors, and the tendency towards herd behavior are timeless elements that continue to shape market dynamics, making the lessons of 1869 as relevant today as they were over a century ago. Therefore, for every investor, every trader, and every participant in the modern financial ecosystem, the historical knowledge derived from such pivotal events is not merely academic curiosity, it is an indispensable asset. It equips us with the foresight to recognize the early warning signs of manipulation, the wisdom to resist irrational exuberance, and the discipline to adhere to sound principles of risk management and fundamental analysis. By internalizing these profound historical lessons, we empower ourselves to make more informed, more resilient decisions, thereby safeguarding our financial futures against the inevitable recurring cycles of speculation and panic. The past, in this context, is not a distant memory, but a vital living mentor, offering guidance to those who seek to command their own financial destiny in an ever-complex world.